This is not 2008 all over again. This is a great normalization after an extended period of 2020, 2021, where the housing market was absurdly high. That was unsustainable. We're normalizing to more sustainable levels. There's going to be some noise in the normalization, but come 2023, you're going to see home sales go up, unit home sales, and you're going to see home prices rise at their historically average low to mid-single digit CAGR. And that's how the market's going to progress. All these calls for housing market crash, way overblown. Great normalization, not great crash.
What's up, HGI investors, and welcome back to Hypergrowth Investing. I'm Aaron Davis, and as always, pleased to be joined by investment analyst Luke Lango. Luke, how are we doing today? We're back for another week.
We're back in action. Good day. You can see right here, it's all green, right? That looks good.
Green looks good.
Stocks have been on a rebound. We got earnings season on the horizon. It's going to make or break the rally. So let's talk about that over the next hour.
Awesome. Well, I'm looking forward to getting into all of that and all of our topics in just a few moments. If this is your first time joining us, Hypergrowth Investing is the weekly podcast that picks the brain of an investment analyst, Luke Lango. Each week, we take an in-depth look at emerging tech and investment innovations, electric vehicles, cryptocurrencies, the metaverse, and more. Nothing is off limits. If you're joining us for the first time, we go up every Wednesday on YouTube, Spotify, Apple, Google, wherever you choose to listen to your favorite podcasts. So make sure to hit like and subscribe to get Hypergrowth Investing as soon as it goes up. Again, I'm Aaron Davis, educator and lifelong learner, and your proxy into the mind that is the Luke Lango. Ton of things to cover. Let's dive right in. Luke, we've talked about the housing market before. You've basically kind of stated where your position is on it. But some interesting things have come out. The National Association of Homebuilders Index fell for the 7th straight month to its lowest level since May of 2020. The 12-point drop from 67 to 55 was also the second largest drop in the history of this index. A shocking drop, and it came in below all 31 analyst estimates. Now, you stated several times on the show that you believe the housing market will not collapse. With this data, does that still hold true in light of what's going on right now?
Yeah, sure. So let's pull up that data for a moment. I'll screen share with you, and we can take a look at that exact data point you're talking about, or rather the time series therein. You got it on your screen?
Coming in now.
This is the NAHB Home Builder Sentiment Index. And to your point, it crashed to 55. It was supposed to be, I think the estimate was 66. It was 67 prior. Big miss, 12-point drop, second largest on record, biggest on record, excluding the COVID-19 pandemic. So you have to exclude that data because it's anomalous. Biggest drop on record, let's call it that. But look to where it's crashing to. It's crashing to 55. So it broke this. This is kind of a critical support level for home builder sentiment. And that's the 60 level. Okay. Sometimes we crash below and it's ugly. Most times we crash below and it's brief. Very brief fall downs below. Very brief. History says that there is nothing truly worrisome about this crash to 55. This happens. There's volatility in the data, and normally we bounce back. 08, we didn't bounce back. We dropped all the way below 10. We're at 55 still. A pretty healthy reading. If you were to look at this chart and say, okay, what's the median reading over the past 20 years? 55 is about the median reading. So we're not crashing to, oh my God, awful levels. We're crashing to normal levels after being highly elevated for about 18 to 24 months. So this is a normalization, not a crash. And that is the whole thesis that we have been painting in this podcast and in my publications for several months now. What we're seeing is a great normalization of the housing market, not a great crash of the housing market. And the two big reasons why I say that is 1, supply, and 2, demand. On the supply front, we are in the most supply-constrained housing market of all time. What happened is that 2008 hit. First off, 2004, 2005, 2006, this American dream of everybody owning a home was the defining theme of American culture. Everybody was involved in that big buying spree. 08 hit, 07, 08 hit. A lot of people lost their homes. Everybody was freaked out. The American dream was broken. And that created a lot of consumer hesitancy in the housing market. Demand kind of fell out. People were very nervous. You had a lot of people in our generation, Aaron, that decided to, maybe I'll stay at home with my parents. I won't go out and buy, the white picket fence with the lawn, my little, 3-bedroom home. Not going to do that. So a lot of people were staying at home. A lot of people were moving to cities and living in apartments and condos. Home buying demand was very weak post 08. As a result, home builders didn't build that much. Home construction activity between 2008 and 2019 was significantly lower than it was between 1995 and 2004, than it was between 85 and 95. It was the lowest volume of home building on record, that stretch post 08. So we basically had a decade plus of underbuilding in the housing market. Then COVID-19 hit, and all of a sudden, everybody wanted to own a home for various reasons. Memories of 08 got wiped out. There was this remote work shift. People wanted to work from home, and so they wanted to look for homes that accommodated that. There was this whole shift towards an enhanced recognition of the value of a home. Home buying demand came back, but we've been underbuilding for 10 years. So you had this massive demand surge against the backdrop of a very supply-constrained market. And now you're seeing those supply constraints still last. Month supply in the U.S. housing market is 2.6 months, meaning that if no new supply came on, it would take 2.6 months at current buying activity rates to wipe out all the inventory. That's very, very low. Normally, you're looking at 5, 6, 7, 8 months. And in terms of when does the market crash, normally that inventory level month supply is up above 12 months, 13 months, 14 months. It starts getting into those double-digit numbers. We're at 2.6 right now. We're very low. New supply has to come into the market for prices to come down. But new supply can't come into the market from existing home sellers, right? Because for most of us, if we sell a home, we got to go buy a home. Not a lot of us own 2 or 3 homes. So the existing pool of homeowners are not going to elevate the supply of homes on the market. The new supply is going to come from home builders. Home builders have to go from underbuilding to overbuilding. But building a home takes a while. It's a 12, 16, 18-month process. And once you've underbuilt for a decade, you now have to overbuild for a decade just to balance out the market. So not only are we in a supply-constrained housing market, but we will likely remain in a supply-constrained housing market for a long time, because in order to get to the point that we got to today, it took a decade of underbuilding, meaning it's going to take a decade of overbuilding to crawl our way out of this inventory hole. So that's the first reason I'm very confident saying this is a housing market normalization and not a housing market crash. The second point is that demand is very, very high. Again, we had a whole generation of people that throughout the 2010s graduated college and either went to go live in cities and owned apartments or condos, not owned, rented apartments or condos, or they stayed at home with their parents. Now that generation of individuals, they're making a lot more money. They're at a point in their lives where it kind of makes sense to either move out of your parents' basement or move out of your childhood bedroom and or get married, have kids, get the whole American dream of, starting your family, having your own home, la-di-da-la-di-do. That generation is now at that point. So there's a whole bunch of demand that's just waiting on the sidelines for any hiccup in the housing market. And any sign that prices are weakening, any sign that we're starting to see price cuts in the market, which we are seeing, any sign that it's flipping more towards a balanced market as opposed to a pure seller's market, there's going to be a lot of demand flooding in. I personally know about a dozen people that are just in my age demographic, this 25 to 35 demographic, that are just sitting and waiting on the sidelines. And as soon as there's any hiccup, they are jumping into the market and they're going to buy. There's a lot of pent-up demand sitting on the sidelines. So low supply, ultra low supply that's going to take a decade to build out of, and ultra high demand that's just waiting on the sidelines. That combination means this is not a housing market crash. This is not 2008 all over again. This is a great normalization after an extended period of 2020, 2021, where the housing market was absurdly high. That was unsustainable. We're normalizing to more sustainable levels. There's going to be some noise in the normalization, but come 2023, you're going to see home sales go up, unit home sales, and you're going to see home prices rise at their historically average low to mid-single digit CAGR. And that's how the market's going to progress. All these calls for housing market crash, way overblown. Great normalization, not great crash.
So if we are in this normalization period and this dip is just, again, the market correcting itself, my question is the 31 analysts who just didn't call it right and are shocked by this, why are they so shocked by this dip?
Well, I don't think they saw the housing market cooling off as quickly as it has. I mean, nobody saw mortgage rates spiking as quickly as they have. I mean, mortgage rates are on the back of their sharpest ascent in the history of mortgage rates. That shocking ascent has led to a shocking decline in home buying activity and in home builder confidence because they're related. They're tied together. So that is the kind of shock that happened here. And so part of the thesis, a kind of third subpoint, it's supply and demand. What's going to help demand in the housing market is mortgage rates have topped out. Go look at the 10-year Treasury yield. 10-year Treasury yield went from 1.5 to 3.5 in about 8-9 months. It is now pulled back from 3.5 and appears range bound at 3%. I was just on my Bloomberg terminal looking at the consensus estimates for 10-year Treasury yields from, again, it was something like 48 analysts, why do a big number. The 10-year Treasury yield is expected to remain range-bound around 3%, 2.9 to 3.1 for the rest of 2022, into 2023, into 2024. People are pricing in rate cuts in 2024 from the Fed because the economy is slowing so dramatically right now. So mortgage rates they front ran all the rate hikes, and now they're pulling back. They shot above 6%, 30-year fixed. It's come back down to 5.75, 5.5. I think it stays range bound between 5 and 6 for a while, and maybe even comes down back into the 4s. I think mortgage rates are actually going to now be a tailwind to the market, not a headwind. As that shifts, that is what's going to bring more demand online. Supply is going to still stay low. That's going to create a housing market where prices continue to appreciate, not at their 10%, 20% rate that they did in 2020, 2021. But again, great normalization back to mid-single digit HPA. That's what we've seen throughout the past 50 years. That's what we'll start seeing again in 2023, 2024, so on and so forth.
Okay. Well, moving on from our homes to how we travel, let's get into our EV check-in. Let's touch on a few of the EV names we've touched on the last few weeks. First up, Canoo. The stock ripped on news. We talked about this last week of the delivery vehicle partnership with Walmart. Shortly after, though, something we didn't touch on was a published press release announcing that they've been awarded by the U.S. Army to supply their multi-purpose platform technology for analysis and demonstration. Before we even get into what this means for Canoo, what does that mean? That they're being supplied their technology is being analyzed for a demonstration. Is this mean that the U.S. Army is buying into Canoo wholeheartedly, or what does this demonstration mean?
First, Aaron, let me pull this up.
Okay.
Let me know when it's on your screen.
Coming up, and it is on now. Yep. Oh, okay. All right.
Isn't that pretty?
That is.
I swear, if Walmart just goes all Canoo and all the delivery vans are Canoo, I am never going to shop at Amazon again. I am going to exclusively order from Walmart, and I'm going to sit on the front porch and I'm going to patiently wait every day for this van to come by just so I can see this van. I know a lot of people don't like the look. I know it kind of looks like a bug, but I mean, God, I think it is so, so, so sexy. I think Canoo cars are the sexiest cars on the planet. Anyways, just wanted to pull that up because I think that's a really cool mock-up design for the Walmart stuff.
Sure.
Yeah, so Canoo, I mean, let's zoom out and look at the big picture thesis on Canoo. Bulls have been lamented as idiots for a long time because the stock has been absolutely crushed. But the bulls have constantly been saying, okay, Canoo actually has this really powerful underlying technology, this multi-purpose platform, MPP, where they've essentially, through a few cool tricks like drive-by-wire, have eliminated all the wasted space in vehicles and removed a lot of the gear so that you can maximize the interior cabin space of a vehicle on the same platform as as a competitor's vehicle. So, for example, the lifestyle car, which is the one they sell to consumers like you and me, it's about the same length as a Tesla Model 3, but has the platform, the car platform. But the car itself has almost double the interior cabin space as a Tesla Model 3. So you're basically doubling your per square foot area of the cabin. And that is a really cool value prop for, I don't know, a family that has 3 kids, 4 kids and a dog, family that travels a lot, a family that backpacks a lot, that hikes a lot, that likes to adventure a lot, that surfs. It seems like that's a really cool value prop for a lot of families in America. Moving on to pickup trucks. You look at the pickup truck, it has 30% more cargo space than a pickup truck of the same size from Ford or GM or whatever. That seems like a pretty awesome value prop for contractors, construction workers, people that use pickup trucks and need that bed to carry a lot of cargo. Let's talk about delivery vans, which is the big news with Walmart. 30% more cabin space on the same platform as a competitor's vehicle. That means less trips, more cargo per trip. So the whole bull thesis on Canoo has always been, hey, they actually have this really cool proprietary defensible technology that allows them to create cars that optimize space. So any customer that wants to optimize space is probably going to buy a Canoo. That's been the bull thesis forever. Now that bull thesis got lost in the sauce because the stock's been hammered. There's been liquidity issues, cash burn, C-suite shakeups, business model changes, a lot of noise, a lot of negative stuff that's happened. And I get that. I acknowledge all that. But at the end of the day, if indeed this company can appeal to space-conscious customers, then the company's going to win. It's going to sell a lot of cars to those space-conscious customers. And the past week sort of validated, and even going back 3 or 4 weeks, validated that big name, big time space-conscious customers do see the value of Canoo. The first deal, which the market didn't really pay attention to, was NASA. NASA signed a deal with Canoo to shuttle astronauts basically to and from rocket launches. Now that makes a lot of sense, right? Because when you think about that, sometimes you have multiple astronauts, you have a lot of gear, you need a lot of space, you want comfort. Makes a lot of sense. That's a space-conscious customer. Makes sense they would sign up with Canoo. Now let's go to Walmart. Walmart, one of the largest retailer in the world, one of the largest logistics companies in the world too, as a result of that, they need to have vans that optimize space. They're a space-conscious customer. They've signed a deal for 4,500 Canoo delivery vans, option to get 10,000 Canoo delivery vans, and an equity grant to acquire 20% of the company. And they made Canoo sign essentially what was a non-compete agreement so that Canoo cannot sell any delivery vans to Walmart's biggest competitor, Amazon. To me, that screams Walmart, space-conscious customer, absolutely loves the value prop of Canoo's delivery vans. And then you have the Army. So there's no deal with the Army. The Army's simply testing the vehicles. But think about the U.S. Army. That's another space-conscious customer. They want a vehicle. They don't care what the outside looks like. They want a vehicle that optimizes the space inside the car so they can transport more troops, transport more cargo, transport more resources. Very important to military operations, to Army operations. That's why they're testing the cars. So if you look at the past 4 weeks, we've received significant, meaningful validation that space-conscious customers do indeed value, to a high degree, the space optimization qualities inherent to Canoo's vehicles. If this scales, Walmart goes from 4,500 to 10,000 to 20,000, 30,000, 40,000 vehicles. NASA says, okay, we got this partnership. Let's do it with all the cars across, all the U.S. space agencies.
Sure.
The U.S. Army is like, this is a really cool car. Let's adopt it. Navy's like, hey, maybe we'll get some. Air Force is like, hey, we'll get some too. If these early stage deals scale, all of a sudden you are talking about a company that is going to produce 50,000, 100,000, 200,000, 300,000 or more cars per year by the late 2020s. That's a company that should be worth tens of billions of dollars, if not more than $100 billion. And you look at the stock price today, and that's simply not priced in. Now, the big concern with Canoo, of course, is liquidity. They're burning a lot of cash. I mean, I don't want to say they were mismanaged. I don't think they were mismanaged. I just think management did not understand the amount of capital that would be used to build these cars, to manufacture these cars, to build the facilities and manufacture the cars. So cash burn's a real issue right there. They're going to run out of cash any month now. But now they have these deals in place. It seems like investors are probably going to want to give them capital, because it's not like, a month ago it was, okay, Canoo, I have this struggling EV maker. There's a couple pre-orders. There's no real sign of enterprise demand. That's risky. I don't really want to give them capital. Now it's like, oh, you have a 4,500 unit order from Walmart that could go to 10,000, and they want to acquire 20% of your company, and they're making you sign an agreement that you're not going to sell to Amazon. Oh, and the Army's testing your vehicles. Oh, and NASA's using your vehicles. All of a sudden, if I'm an investor, if I'm a bank, capital markets, I'm looking at Canoo and I'm like, hell yeah, I'm going to give you some money. I mean, this money I know you're going to use to fulfill a giant order that's going to be worth hundreds of millions of dollars, potentially billions of dollars. So that's why I think the story around Canoo has just fundamentally shifted over the past 4 weeks, fundamentally shifted. And my confidence in the stock, it was shaken. It was. I mean, the stock had been crushed. And when a stock gets crushed that hard, as a bull, you get shook. But my confidence has been restored 100% in this name. And I am very positive on the long-term outlook for Canoo stock, that from its $4 price tag today, you could see a $20, $30, $40, $50 stock in the future. If these early stage deals scale, I think the odds of that are high enough that the risk reward on the stock is attractive. I'd be a buyer at current levels for sure.
Okay, good news for Canoo. Let's also check in with Rivian. We know that this is another one of your favorites for the long haul. So I just want to check in here to see if you could quickly provide our viewers an update with any of the latest goings on with Rivian.
Yeah, so Rivian is the stock's doing pretty well recently. They're, from the looks of it, from the updates we've received, crushing it on the production front. I am personally seeing quite a few R1Ts in San Diego and in LA, in the Southern California area. So I've been personally, kind of the ground level observation does look like they're crushing on the production front. Those cars look amazing on the road. They are head turners. And when everyone is parked in a parking lot, it's kind of like everyone walks by and they're like, what's that? What's that? That's a cool car. What's that? It's a head turner for sure. So really excited about what's going on there. I think the story there is going to continue to build. Momentum's going to continue to build. I think they're going to hit their 2022 delivery targets and really grow in 23. I like the stock long term. It's had a big run up here. And so it's probably due for a kind of a short-term pullback, but then I think after that pullback, it resumes the march higher. So really like what's going on there. They got the Amazon partnership, obviously. So it's kind of interesting when you think about it. All these big companies they kind of have their own electric vehicle delivery horses or makers, so to speak. Yeah. Walmart has Canoo, Amazon has Rivian, UPS has Arrival. And so it's kind of like, as opposed to one supplier supplying all of them, they each kind of pick their own little horse. And I think that creates a lot of opportunities for investors. I would be invested in those horses because those are companies that are being supported by, funded by, backed by very, very large companies that have billions of dollars in the balance sheet and have, in UPS's case, several decades of successful operating history, and Walmart's case as well. So I would be backers of those individual companies, the Arrivals, the Canoes, the Rivians of the world. I like that value prop. I think electric delivery vans is a really exciting space.
So the real question is that Walmart van pulls up to your house, alongside an RT1, which one? You get to pick one. Which one do you keep?
Well, if it's an RT1 that doesn't exist, I don't know. The R1T.
R1T, sorry.
The canoe.
You're driving the branding, though. You're driving that Walmart branding.
I mean, okay, maybe not the Walmart branded one, although I think that'd be kind of cool as well. I love the look of the canoe. I know my wife hates it. My wife's like, oh my God, it's ugliest car of all time. I'm like, babe, it is the coolest car of all. It is the coolest car of all time. I love the way the canoe looks. I think it's super cool. The R1S, I'm not a pickup truck guy, so I would not an R1T buyer, but the R1S is gorgeous. And my wife loves that car. I think a lot of people really think that car is really pretty. So it's nothing against Rivian. I just look at a canoe and I'm like, if I drive that, I mean, if you, for me, it's kind of like, and you know me, I wear Crocs everywhere, right? I wear Crocs everywhere. Crocs, they're the $40, clog shoe that is literally known for being ugly. But it's literally known for being ugly. Yet I wear it everywhere because it is the most useful shoe of all time. I wear it to business meetings. I wear it playing basketball. I wear it doing yard work. I wear it working out, running on the treadmill, lifting. I wear it on a walk around the block. I wear it to the beach. I wear it hiking. I will wear my Crocs everywhere. And that's the beauty of them, is they're so multi-purpose. There is so much utility behind a Croc. That's what I see with a canoe. Canoe is the Crocs of the electric vehicle world. You look at it, and ostensibly, objectively, it's kind of ugly. It looks like a bug on wheels. I get that. But it is the most useful car on the planet. The same length as a Tesla Model 3, yet double the interior cabin space. If I have 3 kids, I'm buying that.
All right.
$35,000, $40,000, $45,000, depending on what version you get. I'm buying that. I can get all their backpacks in there. I can get all their sports gear, their basketballs, their soccer, their baseballs. I'm buying that. If I have 2, 3 kids, that's what I'm buying. It's economic. It makes sense. It can fit everything. It can do, the campers. We can go on road trips with this thing. It's an awesome car. If I'm in the construction industry, I like the pickup truck. I see watch the demonstration of the pickup truck on YouTube. All the kind of like cool little features it has. It was built by pickup enthusiasts for pickup enthusiasts. It's an awesome pickup truck. Again, I'm not a pickup truck driver, but I can appreciate a good pickup truck when I see one, and that is a good pickup truck. And then you look at the delivery van. This is a no-brainer deal for Walmart. A no-brainer. I want a car. I don't care what it looks like on the outside. I want a car that maximizes the amount of cargo I can put in it so that I can do less trips per day with those vehicles. So they last longer. It's more cost efficient. That's your answer. These are the Crocs of the electric vehicle space. That's why I'm so bullish on that. On canoe stock. And, I like Croc stock. I think it's already had its day in the sun. We called that one back in the pandemic and it had a big run. So happy about that. But if you're looking for the next Crocs, canoe.
All right. Next Croc, canoe. Awesome. Moving on. Want to touch on something. We may have touched on it before on the podcast, but we've never really dived really deep into it. Psychedelics. Psychedelic therapies continue to make significant progress in the public eye as well as in clinical trials. Can you explain to our viewers why you're so bullish on this space, particularly psilocybin? I believe that's how it's pronounced. Traditionally, magic mushrooms, and what are the latest developments in that industry?
Yeah, great questions, great industry. Let's start with the history. All right. Psychedelics. When we say psychedelics, we're talking mind-altering substances. So things like mushrooms, magic mushrooms, where the active ingredient is something called psilocybin, MDMA, LSD, ketamine, that class of drugs. Today, and over the past several decades, the world has viewed them as like no, 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 like bad drugs, bad for you. Only druggies do that stuff. But that is actually a misconception that was formed as a result of Richard Nixon's war on drugs. That in the 60s, we had this renaissance of research into psychedelics. And that research was finding that indeed psychedelics, those drugs, MDMA, LSD, psilocybin, specifically psilocybin, they have robust therapeutic potential. That because they can temporarily alter your state of mind, they can also, if used correctly, be used to address mind issues, addiction, ADHD, PTSD, depression. They were found to have early research show that they had the potential to have robust therapeutic potential with those kind of unmet mental diseases. But they also became part of hippie culture, right? In the 60s, psychedelics were a huge part of hippie culture. It's what hippies did. In an attempt to fight back against hippie culture, Richard Nixon kind of had the war on drugs. And because it was basically White House, Washington, D.C. versus hippies, and hippies loved psychedelics, White House decided psychedelics were bad, and they wrote it into legislation. So all of a sudden, these substances became Schedule I drugs, like the same level of badness as cocaine and heroin, which is ridiculous. So that's why we've kind of developed this conception over the past several decades that psychedelics are bad. They're naughty drugs. They're cocaine. They're heroin. When in fact they're not. But nobody challenged that status quo. It just kind of became embedded into American culture. Until recently, over the past, I want to say 10 to 15 years, the academic world, the US academic world decided to challenge that because they opened up their textbooks and realized, hey, way back in the 60s, there were some pretty cool studies going on that were pretty promising. Then Nixon axed it, and then we never saw anything for 40 years. But maybe we should reopen that book. Maybe we should start doing some tests of our own. So then Johns Hopkins, UC Berkeley, UC Davis, Imperial College London, I believe there was a Columbia study or NYU study. All of these top-notch universities started to do studies on psychedelics, specifically on psilocybin. That's been the kind of like the flag waver of this industry. So they all started to do studies on psilocybin. And all of their studies showed the exact same thing. This stuff works. Psilocybin is a magic drug when it comes to curing things like addiction, depression, ADHD, PTSD. And all of a sudden, everyone's like, wait. Maybe we should rethink how we look at these drugs. Maybe they're not Schedule I heroin, cocaine, gonna kill you. Maybe they are things that, if used correctly in the right doses, in the right settings, can beneficially change millions of people's lives. I mean, we're talking the eradication of addiction, of alcoholism, the eradication of depression, ADHD, the eradication of diseases that really plague and hinder people. That's what psychedelics can do. And a plethora of academic research over the past 10 years has proven that. Beyond a reasonable doubt, it has proven that. So as a result of all that research, you're now seeing a wave of companies emerge that are trying to commercialize that research. Take that research, make novel, unique drug compounds out of it, push those drug compounds through clinical trials, and hopefully on the other side of it, completely transform the mental health care landscape so that we can actually treat diseases that currently I would consider unmet diseases. I think addiction's an unmet disease. I think ADHD is an unmet disease. I think depression's an unmet disease. Yes, we have medications for those things, but they're not very good. And anybody who's taken them will tell you they're not very good. Psychedelics represent the next evolution of those medicines, a significant step up, a superior treatment to actually help those people get past those diseases. And so that's the kind of backstory on psychedelics. And we are now finally starting to see the barriers, the cultural barriers get broken down. Netflix, I haven't seen it yet, but there's a new Netflix documentary, I think, How to Change Your Mind. Do you know what I'm talking about?
I haven't seen it yet. It's in my queue actually, but yeah, no, it's
so
up there.
It's a docuseries. I haven't watched it yet. I need to watch it, but I did see the advertisement, and it seems like it does a really good deep dive into this industry. So I would suggest people start there. Netflix has done some other documentaries on this. There's been a lot of pop culture articles on it. So you're starting to see the world kind of turn from a consumer perspective to being like, hey, maybe this stuff's not that bad for you after all. Maybe it could actually be good. And so that's a massive pivot that's happening right now. We're very bullish on psychedelics. We think that there are some stocks out there that are very high upside picks on this space. So really happy to talk about it.
So what does the future of this look like? I mean, you've mentioned that the rhetoric's sort of changing in popular culture. You mentioned that we're seeing some of these drugs going through clinical trials. What does this mean for the future of the industry and, again, for investors moving forward?
Right. So I think one of the things that we really like about psychedelics from an investor perspective is that it's highly defensible. And it's highly defensible because the future is one built on top of drugs that went through clinical trials. There is no greater competitive moat in the universe of finance, in the universe of business, than a drug that went through clinical trials. Because that is one of the hardest processes to get through in the world. The success rates are very low. And once you get through, you then probably have a 3 to 4 year buffer before the next drug comes through and challenges you. So it's a massive competitive moat. And all of the drugs that are being developed here are going through those trials. So a lot of people like to think of psychedelics as like cannabis 2.0, and it's not that at all. You know us. We could not be more bearish on cannabis. Commoditized, anybody can grow it, anybody can sell it. There's no competitive moats being built there. Therefore, there's no margin preservation. There's no profit production. There's no value for shareholders to be had. Don't like it at all. Psychedelics basically learned from those mistakes and is doing the exact opposite. So these psychedelic companies, it's not like anybody can grow shrooms. What they're doing is they're creating novel compounds based on the active ingredient in mushrooms, psilocybin. So that's a patented proprietary process. They're putting that drug through clinical trials. Once it gets through clinical trials, that is another massive moat. Then there's the whole delivery aspect of it. So we're not talking, this is a drug where I go to my doctor, they say, take some psilocybin. I go to my local CVS and I pick up my psilocybin prescription. That's not how these things are administered. They're mind-altering medications, and they do have a tendency to alter your mind. You don't want your mind altered in an unsafe setting. So the setting in which you take these medications is just as important as the medication itself, which is why the companies in the space aren't just creating medicines, they're creating treatment processes. So you go to a psilocybin treatment or a psychedelic treatment center. You meet with a doctor who administers your treatment. Let's call it a psilocybin treatment. And then you're in a room, a very smartly designed, safe room that is supposed to optimize your experience so that you don't feel scared or threatened or some of the negative feelings that can come with psychedelics. And instead you feel the positive stuff, which is happy, at ease, stress-free. So it's not just the medicine, it's the how you administer that medicine. That's another competitive moat. There are companies in this space that are patenting, the administration of those things. So when all is said and done, a psychedelics company in 5 years, whoever the leader is going to be, is going to have massive competitive moats. They're going to have a drug that's been through FDA, that's been through clinical trials. You're going to have a compound that is proprietary and patented. You're going to have a delivery method that is proprietary and patented. You're going to have psychedelic centers that, are yours and owned and nobody else controls them. So I think that there are massive moats here which allow for massive profit production in the future. And that's why we really like psychedelics as an investment opportunity and not just as an exciting new space. So what does it look like in 5 years? You're probably, I mean, there are dozens of companies out there right now developing compounds. I think by 2025, 2026, 2027, you'll have 2 or 3 that actually make it through clinical trials. You'll probably have a psilocybin-based one, or maybe 1 or 2. Maybe you'll have a ketamine-based one. And you'll probably have 3 or 4 of these drugs out there that are going to become the status quo for treating mental health disorders. So as opposed to going to your doctor and getting prescribed Lexapro or some medication, you're going to go to your doctor. They're going to prescribe you some psilocybin-based therapy. Then you're going to go to a psilocybin therapy center. You're going to get those medicines. And over the course of probably a 12-week treatment, you're going to improve the state of your mental health. You don't stay there the whole time. You go there for an hour, you take it, you let your high wear off, and you go back home. You probably do that once a week. That's the future of this industry. That's what mental health care into, post 2025 looks like. We're investing in the companies that are going to be the pioneers or the dominating companies in that world. So that's what it looks like. That's why we're excited about it. Not going to tell you the names of the companies right now. That's for our subscribers. But it's, I think the names there have supremely high upside potential. The best biotech stock to buy right now, in my opinion.
All right. Okay. Good to hear. Moving along, want to talk a little bit about Cathie Wood's ARK. Growth stocks have outperformed in the last month. I know you've pointed out to your subscribers over at Investor Place that some technical analysis shows Cathie Wood's ARK is forming an interesting pattern. Can you talk to us a little bit about what you're seeing there?
Sure. Yeah, I am trying to pull it up right now, but I will describe it as I pull it up. In technical analysis, there's something called an ascending triangle. And ascending triangles are when... So triangles are like a big thing in technical analysis. A lot of technical traders love to look at triangles. It's all about triangles because when a triangle converges, something big happens to that convergence. Now, what we're seeing in Cathie Wood's ETF, the ARK ETF, is we're seeing an ascending triangle. Now, an ascending triangle is, I just got the image, I'm pulling it up, and then I'm going to share my screen. Get that screen share going for you. Okay, let me know when it's on your when you can see it.
Coming in now. Okay. Yep. All right. I'm seeing this. All right. I'm seeing a triangle.
Okay. So here's your triangle. An ascending triangle is when you have this horizontal top. So your resistance line, you have this consistent line of resistance where every time the stock kind of tops out there, tops out.
Okay.
And then you have this increasing support line, this rising support line. So we top out, we come down, we top out, we come down, but we come down to a little bit less than when we came down back here. We top out and we come down back to a little bit less than when we came down here, right? So you have this increasing resistance line with this stable support line, the convergence of the triangle here. Normally, technical analysis says that once you get to this convergence point, you get a massive breakout to the upside. So this is the bullish ascending triangle that's forming not just in Cathie's ETF, but in a lot of her holdings and a lot of these growth stocks. And so I think that's a pretty bullish technical pattern that implies we're due for a short-term breakout in growth stocks. And I think that it lines up fundamentally with where we are in the cycle. Inflation fears have receded. Recession fears are now front and center. The Fed is done playing hard talk. They're doing hard walk. They're actually hiking 50, 75, 75. I think next week they go 75. Looks like 100 is not on the table, so they're probably going to 75. Anyways, that's 75, 75 back-to-back, 150 in a month. That's wild. The Fed is playing hardball finally. Inflation rates are finally decelerating. The growth to value ratio is finally rebounding after a complete plunge in 2022. Yields are coming down. We talked about this earlier. The 10-year Treasury yield front ran rate hikes up to 3.5. Now it's come down back to 3, and most analysts see it range bound in that lower 3% range for the next several years. I think it actually comes a little bit lower. So you are seeing this fundamental shift in markets where, okay, we're going into a recession. The Fed's going to kill inflation. Then what's going to happen? Right? Markets like to look 6, 9, 12 months in the future. They're discounting mechanisms. So let's look 6, 9, 12 months in the future. End of 23, first quarter of 23, mid 23. What does the economy look like at that point in time? We probably have low inflation. I believe inflation falls from 9% today to around 3%, if not 2% by that point in time. You probably have a really slow economy. Because the Fed, in order to kill inflation, is going to hike rates very aggressively. That's going to kill the economy, or at least slow the economy dramatically. So you're probably going to have a really slow-moving economy with low inflation. That's a type of economy the Fed is going to stimulate with either rate hikes or maybe some QE. In that backdrop, a slow-moving, low-inflation economy with rate cuts, with potential QE, that's the 2010s backdrop. What happened in the 2010s? Growth stocks, ARX ETF, tech stocks soared. They were the biggest winners. So I think we're moving back to that environment. I think this whole 2020, 2021, 2022 thing is like, it's this weird 3-year anomalous period that is now normalizing. The housing market's normalizing. We talked about that. I think the financial markets are normalizing. 2020 pandemic hit. Oh my God, weird. 2021, whoa, we got all this stimulus because of the pandemic. Boom, 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 boom. 2022, oh, we got to pay back for all that stimulus. Gosh darn it. Cycle's done. That cycle's done. We've ripped through this cycle. We had the massive crash, the huge stimulus, paying back for the stimulus, and now we're going back into a new cycle. So this cycle is almost done. And if so, that means we're going to be in a new cycle, early cycle in 23. What performs in early cycles? Tech stocks, growth stocks, the stuff that benefits from stimulative monetary policy, and the stuff that grows and helps drive growth throughout the U.S. economy. So I think this cycle is kind of run its course. We're nearing the end of it. As we near the end of it, these stocks are going to soar. The technicals are showing us that right now. I believe a couple weeks ago, maybe it was last week, we talked about the breadth indicator, the number of NASDAQ stocks trading above their 200-day moving average, how it flipped below 20% to above 20%. 100% of the time, that leads to big rallies in tech stocks over the next 60 days. We're seeing the growth to value ratio rebound meaningfully. We talked about that. We're seeing really aggressive insider buying in tech stocks. So there really is this mountain of evidence piling up right now to support that thesis that this cycle, we've ripped through it, and we're about to go into a new cycle where tech stocks, growth stocks are actually the market's biggest winners. And I think today, before we started this call, let me pull it up. I mean, our growth stocks were rallying like crazy. And again, they're continuing to rally like crazy. And that's continued what has been a solid month of very significant outperformance in the growth sector. I think that continues. I think that persists. The one caveat there is the upcoming earnings season. I think this rally, this recovery is not going to be linear. 2 steps forward, 1 step back. 2 steps forward, 1 step back. I think this earnings season is going to be a pretty big 1 step back. Earnings are not going to be good. Companies are going to guide down. Managements are going to sound cautious, pessimistic. Earnings estimates, they're just now starting to come down a little bit. They're going to start to come down a lot. Against that backdrop, I think stocks are largely priced for it, but still, just the optics of it, you're going to get sellers into the market. I think we take a step back, and then we take 2 steps forward. So I do not think it's like, woo, off to the races from here, but I do think it's 2 steps forward, 1 step back with the earnings, 2 steps forward, then something's going to happen, 1 step back, 2 steps forward. We're going to zigzag, but we're going to zigzag up. And that's good. That's healthy. Straight line rallies aren't sustainable. Zigzag rallies, entirely sustainable. So I want to see that. I want to see 2 steps forward, 1 step back, 2 steps forward, 1 step back. The problem is we've been doing one step forward, two steps back, one step forward, two steps back. And I think that reverses.
So you guys are catching up to date.
And I think that reverses now. I think we do two steps forward, one step back, two steps forward, one step back. That's my school of thought. I think there's a lot of evidence supporting that school of thought. So that's where we are today.
All right. Well, moving into, and you touched on it a little bit already, but the Fed is set to hike rates again next week. Expectations are for another 75 basis points, possibly. And there's been talk of a 100 basis point hike. Is this like last time where you explained it, where they're saying 100 so that when they say 75, it's like, oh, okay, cool. It's 75, not 100. And can you explain, if it is 100, how that's in the cards and what investors should look for from the Fed?
Yeah, I mean, I think they should go 100. I do, but I don't think they will.
Okay.
Recent commentary suggests they're definitely not going to go 100. Waller, I think 3 Fed officials over the past 3 days basically have come out and said, yeah, maybe we're not going to do 100. They're saying, hey, 75 is large. Like, that's a huge hike, and it is. That's a jumbo hike. We don't want to, do more than that. Like, that is sufficient for the market we're seeing, for the economy we're seeing, for the inflation we're seeing. So they're probably going to go 75. I think the market's going to celebrate that because it's not 100. Okay. I think they should go 100 because I want to kill inflation. The faster, the better. Like, let's just machine gun inflation. Let's not try and throw darts at it or take a pistol to it. Let's get an AK and let's just destroy inflation. That's what I think they should do. But, 75 is good enough. It's more than 25. It's more than 50. So 75, 100, fugazi. I think, half dozen one, 6 the other. It's going to be good either way because the Fed is now fully fighting inflation. I think the market will celebrate 75. I think yields will continue to stabilize. I think it provides a basis for stocks to move higher. And it'll probably be, if we do get a step back because of earnings, the Fed going 75 might be what helps us get those 2 steps forward after the earnings pullback. But they're kind of happening concurrently to one another, so it's definitely going to be a tug of war over the next few weeks between what the Fed does, which I think will be beneficial for markets, and what earnings will look like, which I think will be detrimental to markets. So I think we're going to get that tug of war, which is why I'm expecting volatility over the next 4 weeks, after which I think we take 2 big steps forward.
Okay. Quick pivot to a topic we haven't really covered on the show before, but something I know you wanted to talk about, and that's venture capital. Can you give us a quick overview on why you watch the VC markets and what are the most interesting trends that you're currently seeing in this space?
Yeah, so why I watch the VC markets is they're tied to the public markets. I mean, VC investments they have IPOs and they become stocks that you and I trade and own and invest in. So it's very important to watch the pipeline of VC ideas, VC money, to know, okay, what are those guys excited about? What are those firms investing in? Where's the money being allocated? To get a pulse for what's coming next in the IPO market, what's coming next for stocks. I think that is a really good kind of leading indicator of the stock market. And what we're seeing in VC right now is definitely a pullback in funding. Absolutely. We've seen a pullback in 2022 in funding, but that pullback's been concentrated in large cap being kind of late stage deals. Then we're actually seeing a acceleration in seed funding, that the earliest stage companies, very small startups, are getting more funding than ever. And that's very typical in recessions. VC behavior is such that we still have all this money because we raised a bunch of money, but we don't want to pump it into companies whose valuations got bloated. So we're going to pump it into new companies where we can kind of set the valuation on our own terms. So you're seeing a lot of money flow into seed funding. That's interesting and very typical because, like I said, that's what normally happens. The other thing we're noting is that there's been a lot of money flowing into 3 industries. One, clean tech. Tons of money going into clean tech, whether it's energy storage, whether it's batteries, whether it's EVs, solar, hydrogen, lots of money going into hydrogen. There are a lot of VC dollars being allocated to clean tech right now. Number 2 is ag tech. We're seeing a lot of VC dollars, record ag tech funding. The whole VC market's down. Ag tech funding is hitting new record highs. A lot of money going into agricultural technology right now. And the third area is automation. We're seeing a lot of money being kind of funneled into robotic startups, AI startups, supply chain automation startups. These are companies that are seeing an uptick in funding in the current market. That gives us confidence in saying, okay, VCs clearly believe those areas of investment will drive very strong growth during this economically turbulent period and after it passes. Those are high conviction investment opportunities. In the stock market, we're trying to invest in those opportunities. We're trying to invest in ag tech, clean tech, and automation. If there are three areas of investment to concentrate in right now, I would say it's those three. Clean tech, go get yourself some EV makers. Look at the battery companies. Look at energy storage companies. Hydrogen, super bullish on hydrogen. Ag tech. Look at we talked about vertical farming recently. Look at some vertical farming stocks. Maybe look at some chicken stocks, as weird as that may seem. But I think there's a lot of innovation going on in ag tech that's worth looking at. Synthetic biology is actually a really interesting, a kind of tangential play on ag tech. So go get yourself some exposure to that. And then automation. Go look at the robotics companies. Go look at the supply chain automation companies. Look at the AI companies. Let's go and get some exposure to those. So that's where the VCs are increasing exposure at the current moment. That's where I think investors, public investors, should be increasing exposure to as well, so long as your plan is to buy and hold those investments for the next 3-5 years, because that's what VCs do, right? VCs are the quintessence of buy and hold folks. They aren't, okay, I'm buying now, I'm trading out in 3 months. Their money's locked up.
Yeah.
They pump in millions, sometimes tens of millions, sometimes hundreds of millions, sometimes billions into certain investments, and then just sit and wait for 5-10 years for that to compound and generate enormous returns. That's what they do. So if your investment philosophy is like that, then follow the VCs. And VCs are in clean tech, ag tech, and automation. That's where I want exposure right now. That's where I suggest other folks get exposure to as well.
Okay. Good to know for VCs. Going into our crypto check-in, crypto is notching a mini breakout from that critical 20,000 level. Are you reading into this much, or should we continue to expect a slow grind?
Yeah, so we saw this little breakout coming. Kind of wrote about it to our subscribers last week. Let me show you the kind of chart that we showed them, letting them know, hey, 20,000 shown pretty good support. We're actually kind of forming a little uptrend here. We're probably going to make a run to 23. And indeed, it looks like we're running to 23. Last I checked, we were 22.8. Where are we right now? That was not a rhetorical question, Aaron.
No. Where are I that's a good BTC. We are at 23. Oh, we're over 23 right now.
There you go. Broke 23. So as you can see, that's what our chart that we
broke 23. Yeah.
Can you see it on your end, Aaron? This chart?
Yep. You can see it on my end. Yep.
So as you can see, this is exactly what we were telling subscribers would happen. We said we'd kind of run towards an above the 23 level. Look here. So here's when we've been consolidating around 20,000. 20,000 is that critical support level. We talked about it, so many different times, why this is a level at which Bitcoin could bottom, right? I mean, you have the realized price lines right around there. The RVT ratio spiked to abnormally high levels at around 20,000. Dormancy flows collapsed to very low levels. Price spent ratio between long-term holders and short-term holders has risen above 1 around these $20,000 levels. Again, that's consistent with bear market bottom. So Puel multiple, Mayer multiple, there's all these on-chain metrics that are just screaming 20,000 is a bottom. Looks like indeed it is. Broke 20, rebounded. Broke 20, rebounded, broke 20, rebounded, broke 20, rebounded, broke 20, rebounded. So very interesting. More interesting, the lows are getting higher and the highs are getting higher. Mini uptrend here at that support. We said, okay, this is where we were on Saturday. We're going to make a run to 23 next week for sure, easily. That's where we are. Looks like we broke above 23. So naturally, we kind of expect a little pullback now. Come back down. Maybe we retest 20. Then we come back up. So I think that this little formation is going to persist. I don't think we're going to all of a sudden now run to, let me stop the screen share. You're kind of sick and tired of looking at that chart probably. I don't think now we're going to all of a sudden run to 30, 40, 50, 60, 70. This is not the new boom cycle. This is strength in a consolidation period, which I expect to persist into the end of the year. Then once you get a Fed pivot, once things start to really shift in terms of liquidity flows in the market, then I think you start the new boom cycle. That's probably Q4 2022, maybe first half of 23. I could be wrong on that. It could be starting earlier for sure. That's why we're invested. But we're not expanding our risk, right? We're staying concentrated. We're staying narrow. We're staying slim. We're staying focused on a very few number of crypto holdings until this thing really starts to show us that maybe it's done consolidating. Then we'll expand out. We don't think that's what it's doing right now. This is expected strength in a consolidation period. Therefore, we're staying focused. We're staying narrow. You can trade in and out of this. Pretty easy to trade in and out of this right now, I think. Once we start to see signs that it's a little bit more than consolidation, we'll expand the risk back out, start taking more shots on different alts. But for now, stay consolidated, stay focused. I think it continues to consolidate around that 17, 18, 19, 20, 21, 22, 23 level. I think we're kind of in that range. If we start breaking to 25, 26, we'll talk again next week. But for now, I think we're still in that range.
All right. Sounds good. Well, that's all for our topics. We do have one fan question this week from Danny Luong. Luke, do you think the biotechnology, genome editing, sequencing will explode soon, like say within 1 to 2 years, or is it still at the infant stage and is it too early to get in? Thank you.
I think that genomic sequencing is a little early.
Okay.
I think synthetic biology is a bit more advanced and worth looking in, but in terms of like actually editing genes and doing things in vitro with humans, I think we're very early on that front. Next 1 to 2 years, will there be major technological developments? Absolutely. Will any of those technological developments immediately lead to commercialization? Probably not. Probably not. So I like the space, but I like it on the understanding that I'm going to be holding the investments in that space for probably over 5 years. And I expect to make many times my money over that 5-year period, but I'm not looking for anything over the next 12 months. Having said that, those are the types of stocks that will soar if what we just talked about does come to fruition. If this market shifts back towards growth, early cycle, technology, yields stay stable in the 3% range, inflation comes down, economy slows, gene editing stocks are the exact types of stocks that will lead that rally. So could they be due for a massive short-term breakout? Absolutely. These things trade in unison. Rising tides lift all boats. They'll be one of the boats that gets lifted if this tide rises, for sure.
All right. Well, great insights for our listeners and HGI investors as always. Luke, any last words before we wrap?
No, Aaron, I had a lot of fun this week. I really like touching on psychedelics. I think that's one of the most misunderstood and underrated investment opportunities in the market today. My certainty there is near 100%. Maybe the companies that exist today won't be the ones that commercialize it. I think some of them will be, but the science there is foolproof. Psychedelics are going to reimagine mental health treatment as we know it. And by 2030, I'd be shocked if there were any medication in the market that was not a psychedelic-inspired medication for ADHD, depression, addiction, so on and so forth.
Well, hopefully we both get a chance to take a look at that Netflix documentary before the next time we talk about psychedelics. And I want to thank everybody for listening. Please, if you have any questions or comments for Luke, leave them in the comments section. We love to hear your feedback on any topics you'd like us to cover and see if we can answer any of your burning questions. Until then, please don't forget to like and subscribe, and we will see you next week. Bye, all.